Your Excellencies, distinguished guests. I'm extremely honored to be asked to attend this International Arab Banking Summit 2014 and to speak before such a distinguished audience. And I wish to thank the Union of Arab Banks for giving me this opportunity. I'm delighted to see so many friends with whom I had the honor to associate with, especially during my tenure at the Central Bank of Jordan. I wish you all a successful conference and a pleasant stay in this very special and beautiful city. Of course, in this regard, I wish also to join previous speakers in thanking His Excellency President Hollande for sponsoring this meeting and for hosting this annual conference. Your Excellencies, ladies and gentlemen, this meeting takes place at a time when the countries of the MENA region are going through a historic process of transition, and when the global economy is showing signs that are challenging the prevailing economic wisdom. Creating jobs, especially for the young and for women, in an environment of low economic growth is a challenge that many countries face today. Moreover, the issue of inequality, both on the national and global levels, is gaining increasing attention, as evidenced by the important work of Nobel Prize winner Joseph Stiglitz of Columbia University, entitled The Price of Inequality, and the rising popularity of the recent work of Thomas Piketty on inequality in major market economies. Many commentators believe that the feeling of inequality, both at the national and global levels, will ultimately lead to violence and extremism. The past 5 years have been unprecedented in terms of the several shocks that the global economy and the MENA region and the MENA regional economy had to endure. The global crisis of late 2008, the Eurozone crisis, the sovereign debt crisis, and the Arab Spring have been historic both in magnitude and in their aftermath. More recently, the Syrian crisis has added to the burden of countries hosting Syrian refugees, as well as to the degree of uncertainty in the region. It was hoped that the Arab Spring may bring a new social contract and better governance with no exclusion and with the access to opportunity and participation for all. It does seem that the lack of established political parties and democratic tradition contributed to the present political upheaval. Moreover, strictly speaking, the global economy is not yet in a post-conflict mode. Global imbalances are still a hanging issue. Protectionism and currency wars, although not explicit, can still be felt by those following up the state of the world economy. Clearly, the banking industry does not operate in a vacuum and will have to be concerned regarding the above-mentioned challenges. In the post-global crisis world, several quarters have suggested that the banking and financial industry should, and I quote, go back to basics, unquote. On previous speaking occasions, I did voice the same sentiment. However, it is important to elaborate on what back to basics really involve. I would suggest that going back to basics can be interpreted in several ways. It may mean that banks should do only what banks do best, buy deposits and sell loans. If that were true, financial innovation would come to a halt. This is not a desirable outcome. There is enough evidence on the positive contribution to the welfare of consumers and borrowers due to financial innovation. However, what seems to have been missing during the most recent episode of financial innovation was the lack of adequate disclosure of risks. associated with the new financial instruments. Furthermore, almost all other participants, including the rating agencies, seem to have grossly underpriced the risk premium associated with the new instruments. And what about regulations or the oversight regime? It is ironic that the regulatory structure prevailing up to the global crisis was the outcome of the process of deregulation that started in the United States in 1982, followed by the Big Bang in the City of London. That regulatory regime has been, to a large extent, the response of regulators to the financial innovation that took place in earnest in the late 70s and early 80s, prompted by Regulation Q. As you might recall, Regulation Q suppressed interest rates in an environment of double-digit inflation at the time. Banks, in search of higher yield, had to develop financial instruments not subject to Regulation Q. Looking ahead, I suggest the lessons to be drawn from both episodes include the following. One, the more regulations put a cap on yield, the higher is the incentive to develop instruments that are not subject to regulations and thus offer a higher yield. Second, any change in the economic environment, including low inflation environment, as was the case during the Great Moderation decade, the past decade, as well as high inflation environment, as was the case during the late 70s and early 80s, would lead to financial innovation in search of higher yield. Chairman Ben Bernanke at the time cited deregulation, low interest rates, and technology or financial innovation as reasons for the subprime crisis. The managing director of the IMF during the annual meeting back in 2007 suggested that the housing crisis arose in part because investors did not exercise sufficient due diligence, but they were also impeded in exercising due diligence by a lack of transparency and disclosure about the risk profile of the new structured credit instruments. Against this background, I would suggest that quote-unquote back to basics should be a concept not in isolation of either the regulatory framework or the change in the economic environment, but rather should be consistent with both considerations. Lax attitudes towards regulations should not be tolerated by the regulators, and the pricing of risk should neither lead to a global banking crisis nor cause a credit crunch. More importantly, I would suggest, back to basics should also mean going back to the basic values historically associated with the banking profession, namely integrity and good governance. Upholding those essential values will be our best defense against greed and excesses, misuse of financial innovation, and non-compliance with regulations. In this connection, the financial sector can play an important role in responding to the post-conflict rehabilitation needs in developing and transition economies. The World Bank, for one, was conceived during World War II with the initial goal of helping rebuild Europe after the war. In the 1990s, the European Bank for Reconstruction and Development was established to help build a new post-Cold War era in Central and Eastern Europe. In post-conflict countries, it is the responsibility of the financial sector to channel resources to areas where benefit is needed the most. Funds should be channeled into rebuilding infrastructure, investments in health and education, and to economic sectors that can provide sustainable economic growth and job opportunities. Financial institutions in post-conflict countries also have a social responsibility to fulfill. In taking their decisions, They should take into account the social and environmental consequences of their activities. Banks need to provide access to finance for small and medium-sized business, which have proven to be a major catalyst for economic growth around the world. And we heard this morning that the French banking system is forthcoming on this aspect. Financing should also be used as a tool for poverty reduction, particularly through microfinancing. Low-scale financing to low-income individuals have proven to be a powerful tool for the economic empowerment of the marginalized when deployed correctly. During post-conflict recovery, the pressing need for reconstruction can be enhanced by a redirection of spending from military to other uses. Many countries improve their fiscal situation by managing expenditures and mobilizing revenues in a prudent manner. Countries emerging from post-1990 conflicts generally incur much larger deficits than those emerging from earlier conflicts. But external support, particularly from the international financial institutions, allowed governments to achieve macroeconomic stability. My final remark relates to our region and what should be done to ensure that we do have a role in the new order which is still evolving. I think the evidence from the global crisis suggests that the conservative policies of central banks in the region, as well as the relatively conservative management of the banking industry, were well placed. Back in 2009, while the global banking system was facing major problems, banks in my country, Jordan, had a liquidity ratio of over 150%, non-performing loans averaged 6% of total credit extended, and 70% of those non-performing loans were already provisioned for. Capital adequacy ratio was around 19%. The banking system was in a healthy state and did not need any public funds to help it go through the crisis. My last remark relates to the role of regulators. And the role of regulators, at the end of the day, is to enhance confidence in the national economy and in the national currency. I would further suggest that confidence is best served by sticking to basics, namely good governance, integrity, as well as minimizing uncertainty, of course. I thank you for your attention.